After languishing under the $72 mark, Brent crude prices have surged to the top to the $81 level. Since Israel-Iran tensions began, crude prices have risen over 10%. Since then, threats of escalation and an all-out war have been rocking the Middle East. This has come as a key negative for crude since some experts are suggesting that Brent crude could actually breach the $100 mark. An all-out war in the Middle East would cripple the world's oil infrastructure and could lead to Tehran, the capital city of Iran, shutting down the Strait of Hormuz, which is a key route for connecting Middle Eastern crude producers to the global markets. So what do rising tensions in the Middle East mean for India? Well, crude oil is an extremely important resource for our domestic markets, especially since India imports about 80% of its energy. After coal, crude contributes the most to our energy supply. India is therefore vulnerable to fluctuations as it can significantly impact our macroeconomic stability. After all, crude prices dictate a quarter of our import bill and have a heavy influence on domestic fuel prices, inflation, and our exchange rate. First, let's look at how crude fluctuations impact our current account deficit. But first, what is the current account deficit? Simply put, the CAD, also known as the current account deficit, just measures the difference between the values of the goods and services a country exports versus the value of a good and services that the country imports. For FY24, the CAD of India was about $23.2 billion. However, with increasing oil prices, the amount of money flowing out of India will also increase. Reports suggest that every $10 rise in Brent crude prices widens India's CAD by about 0.5%. This has a negative effect on our currency. Higher oil prices lead to a bigger current account deficit, which can lower the demand for rupee and make it weaker. As markets anticipate a weaker rupee, they start selling it off, adding even more pressure to our currency. Another reason for crude oil fluctuation impacting the rupee is that during high fluctuations, most of our OMCs try to buy crude in advance, worrying that prices will shoot up much higher. But here's the catch. They have to purchase crude in USD, which boosts demand for dollars and actually puts pressure on the rupee. Here's a not-so-fun fact. Recently, there has been a lot of chatter about FIIs or foreign investors moving to China. But did you know that a weaker rupee also contributes to foreign investor selling? Global investors always think of returns in dollar terms, and any depreciation in the local currency or potential threat of currency depreciation can cause these investors to stay away from such investments. So, back to crude. As if squeezing our current account deficit and the rupee wasn't enough, it also fuels our inflation. When we import pricey crude oil, we're not just bringing in oil, we're also importing inflation. Those high crude prices mean that companies that rely on oil will also have to hike their prices for us, and that's how inflation keeps climbing. Additionally, if we look at the import intensity of India, it's still really high. So therefore, the cost of all goods imported increases as the rupee weakens, thus putting pressure on our CAD as well. Rising crude prices along with a falling rupee can actually impact corporate profits, having a negative impact on the stock market. Some of the key companies impacted are paint and tire companies who require a lot of crude for producing their goods. OMCs refine crude oil into petroleum products and will see their input costs surge, which impacts their bottom line. Over the past 2 decades, crude oil prices have rarely sustained about the $90 mark for a long period, except during times of war. Even in cases where there is an overshoot in international crude oil prices, historical trends suggest that a correction is likely.